Well, hello everyone, and thank you so much for joining me for another episode of the New Construction Marketing Podcast. I'm your host, Anya Christianten, and I'm excited to introduce my guest for today. His name is Yonah Weiss, and Yonah is an expert on cost segregation. So it's a little bit of a different topic. So you guys may want to pull over your cars, or if you're sitting in your model, definitely get your notes out, get a pen out, because this is going to be an action-packed podcast episode. You definitely want to take lots and lots of notes, lots of learning opportunities today. So Yonah, welcome to the show. Thank you so much for being here today.
Thank you, Anya. It's my pleasure, and I really hope your audience can get a lot of value from what we have to discuss today.
I think they certainly will. So, Yonah, if you don't mind giving us a little bit of a background information on yourself, what's your story? How did you get to where you are now?
I have a kind of long story. I'm going to shorten it, but basically I have about 15 years as a teacher in education. And I love teaching. I actually have 6 children, so it's kind of part of my personality to just be totally hands-on involved in, education. But, got involved in real estate really kind of fast forward about 5 years ago. I'm originally from Southern California, but out on the East Coast, and actually spent many years living in Israel. So there's a lot of, all over, a little bit of a world traveler. And recently I got involved in real estate as a broker. I wanted to kind of learn about how to buy a house, what buyers are looking for, really for the purpose of investing. Because I thought, that's where I'm going to gain the most for my, generational wealth in investing in real estate. So I started learning everything I could about that in terms of commercial mortgages, doing everything in the topic of real estate, which kind of led me an interesting path to a bunch of different side jobs, which eventually led me to the company I work for currently, which is Madison Commercial Real Estate Services, which were kind of an umbrella organization that has a number of services. The main thing I focus on is the cost segregation services. So I'm on the business side of the company as a business director, but we have a number of other services. Title insurance, we're a national title insurance, commercial title. We do a 1031 exchanges, qualified intermediary. We do lease abstracting and financial due diligence, environmental due diligence, a bunch of niche kind of services for the commercial real estate investor. And that kind of brings me to where I'm at. And I'm so passionate about cost segregation because it's something that helps people pay less income tax, for investors specifically. And so I'm going around trying to, speak to as many audiences as possible, whether it's live, whether it's webinars like the podcasts or webinars like this. So I do appreciate you having me on your show, and hopefully we'll jump right into it.
Yes, absolutely. So you guys, I think as we're heading into kind of a off season for real estate, heading into September here, one of the things you may want to consider is broadening your audience to the type of people you can sell to. And so the more you can educate yourself on the investor side, the more you can have those conversations with your investors, and the more likely they're going to be to purchase from you. And who doesn't want a little extra sales here and there? So, talking about investing in real estate, there's obviously been so many changes recently with Trump in the office. I think we're all still trying to wrap our hands around like what's going on with tax deduction ability for, your primary residence. That's gone away. I don't think that's ever applied to investment properties, if I'm not mistaken. But there's obviously so many different changes with tax codes constantly happening. So, obviously we'd love to know what are some of the benefits of investing in real estate, because more and more people are getting into real estate. It seems like everywhere you turn, it's a real estate investor, right? Everyone's trying to be a flipper. Everyone's trying to rent the houses out, which is great. And of course, on the new construction side, that's a perfect opportunity for somebody coming into real estate that may not be so familiar and have maybe huge reserves of money on the side for emergencies, because typically new construction will offer builder warranties, and hopefully you are dealing with the brand new home, so you are less likely to have some of the issues that may arise with the purchase of an older property. So hopefully
Sure.
less phone calls from your tenants. So real estate, especially new construction, is certainly a great opportunity for investment properties.
Mm-hmm.
So you guys get your notes out, because what we're going to talk about is the benefits of cost segregation. So this specifically applies only to rental investment properties, so not primary residence. So when you're dealing with investors, here are some talking points.
Right.
So
And I think and I think it's a great point you bring up, Anya, that so many people are getting involved in real estate investing more recently. And I think it has to do with the widespread of the education that's available now, because, traditionally real estate investing was kind of reserved for, very high net worth individuals and families that, had, large estates and large real estate holdings, whereas now people are realizing, hey, the rich people are making money through real estate. And I think it's some, astounding statistic, like over 90% of the world's billionaires, right, invest in real estate, right? And it's like, it seems like a no-brainer, like wealthy people own real estate. And even if they're wealthy through other businesses, they take that money and put it into investment properties, which produce, constant cash flow, and that money appreciates, goes up in time. But one of the, kind of most underlooked aspects of investing in real estate is the tax benefits that come along with it. And whether you agree with, Trump or not, and I'm not going to get into that at all, but he's a real estate investor, okay? And no one can deny that. And he's built his wealth through real estate investing. So it's of no surprise that when he came into office, there were some major changes in the tax code that helped real estate investors even more than they ever did before, which was already a lot, right? Because there's like a kind of unproportionate amount of favoritism towards real estate investors when it comes to the tax benefits. So one of those things is, and this is really what we're going to talk about today, is depreciation. Okay, cost segregation is just a form of depreciation. It's kind of like a more complex form of depreciation, which we're going to get into kind of how the mechanics of that works. But depreciation, take away the negative connotation of what it means. The definition of depreciation and the definition of depreciation, how it applies to real estate taxes, are two completely different things. Okay, so we have to define those terms, or else we're just going to be confused. Because we want our properties, investors are always looking, how can I appreciate, how I can force appreciation, how can I get more value into the property, how can it go up in value as time goes on, whereas depreciation means it's going down in value. And I don't want that. But that's the textbook, dictionary definition of depreciation. But the tax definition of depreciation means that the IRS gives a tax benefit, a tax write-off, based on the hypothetical, right, the theory that things go down in value as time goes on. And they gave it this name called the depreciation deduction, okay? But it's not really, the property's not going down in value. It's actually going up in value. And the deduction you're taking doesn't take away from the value of the property either. Okay? It's just based on the fact that you own a property. The IRS gives you this depreciation deduction. Okay? So that's, just to set the stage of what we're talking about here. Okay? Depreciation is a really, really good thing. Okay? It's really good. And it's totally positive. And it does not take away from the value of the property. So how does depreciation work? Okay, let's step up the mechanics, and then we're going to get into the really weird, complicated cost segregation, which is not going to be complicated at all in another few moments when we understand how it works. So depreciation happens when you buy a property. Okay, let's say you buy a property for $1 million. Just take a round number. the purchase price is how we define depreciation. Okay, so even if the building was built in 1910, and again, this goes to the fact that depreciation doesn't have to do with the actual, value or the life. What's the word? The useful life of the property. Even though, kind of a side note here, for financing purposes, for mortgage purposes, and for appraisal purposes, they will give useful life and values to everything in the property. They'll say the roof has a 10 or 15-year useful life, right? And after that, it doesn't have the value. You have to replace it, the carpeting, etc. And that's what we're going to get into, which this is based on. But the actual value is going to be really kind of, I even like to think of it as kind of like ethereal. It's just like hypothetical terminology. Hypothetical not tax deduction, but hypothetical depreciation, if you will. Okay, so you'd buy that $1 million property. We always have to allocate a certain amount for land. Land does not depreciate. Okay, so we say the building is worth, $800,000, and the land is worth $200,000. Okay, so 20% allocation, and that's great. So that 20%, that $800,000 is now depreciated, that amount, over the course of 27.5 years. That's the life that the IRS gave for residential properties, and it includes multifamily as well. Commercial properties, just so you know, depreciate on a 39-year schedule. So they take that and they depreciate that over 39 years. So residential has a better tax benefit than multifamily. Single family has better than other commercial properties.
Interesting. So let me ask you this. So after that initial 27-year period, if you're still holding on to that property, then since you no longer can depreciate it, maybe, not a bad idea to do 1031 exchange at that point?
Or sell it, whether you're selling it through a 1031 exchange or just selling it outright. There's no more depreciation deductions from that property. Once the 27.5 years has, passed by, there's no longer depreciation deductions that can benefit from it.
And one more question on that. So
go ahead, yeah.
27.5 years from the life of the property, so meaning it's new construction, or from the time that I, as an owner, purchased that property?
Oh, so that's a great question, because in new construction, it's a really good question. The actual term for when the depreciation starts is called when it's placed in service. Okay. So if you're buying a property that's already rented out, for example, then it's placed in service on the day you close on the property. If it's a new construction, it may not be placed in service at the time when you close on it, because there may not be tenants yet in it. It may not be tenant ready. However, in many cases, you are buying it, unless you're just buying it on paper before it's completed. But let's say you're buying it, it's already completed and ready to go, ready to be rented out, or already rented out, then that placed in service date will be, that date when there's tenant ready.
So
that's actually a really good question.
Okay, so it really applies to the person who buys the property, not so much to the property itself. So meaning that if I buy a property and I write out that 27.5 year mark, then I go ahead and sell the property to a new investor. Now, new investor can also write that new 27.5.
That's right.
Depreciation life.
Yeah. So now he starts over his depreciation on this property from day one, which again is what I'm talking about. That it's kind of like this theoretical, depreciation.
Right.
Which the amazing thing is that when you bought this property, for $1 million, okay, and then you depreciated it, you took that tax deduction of the entire value of the property over 27 years, okay? Now, when you sell it 27 years from now, guess what? It's probably worth a heck of a lot more than it was when you bought it, right? It may be worth $10 million in 27 years, right? That new buyer now takes depreciation, takes that write-off on the entire $10 million, the entire amount that he bought it for. So again, it's totally based on the day that it's bought and the purchase price.
Okay.
So really good question. So what we're doing with depreciation is we're writing off the entire value of the building over that 27-year period, okay? So a little bit every year, that $800,000, if you split that up, divide that up to 27, it's around $30,000, something like that, about maybe $28,000 every single year. Okay, that's the amount. You take that as a tax write-off. What means that you deduct that, it's a deduction, you deduct that from your income. So let's say you make $50,000 a year, the net operating income on the property, right off the top, you take off that $30,000, you're only taxed on the remaining 20. Okay,
Wow.
so that's how
That's
depreciation
huge.
works. Yeah, it's huge, right? Instead of paying, let's say you have a 30% tax rate, or maybe it's even more, 39% tax rate, instead of paying that 30% tax on the entire $50,000, okay, you're going to end up, that's $15,000, you're going to only end up paying after depreciation deduction, you lower that down, only going to be paying on the $20,000, okay, it's much less, only about $6,000 of tax, so it's a much bigger tax difference.
Okay.
Comes cost segregation, okay, enter cost segregation. Let's just get rid of the weird name for a second, okay, cost segregation. It used to be called, it's really interesting, it used to be called in the IRS component depreciation, which we're going to see in a second is exactly what it is. Okay, we actually are dividing up or compartmentalizing everything in the building into different depreciation lives. There are some things in the property that depreciate over 5 years on a 5-year schedule, like personal property, appliances, furniture, fixtures, carpeting, all the stuff that's not part of the main structure of the building depreciates over 5 years. Okay, so we're depreciating that at a faster scale, faster rate through cost segregation. The second category, which is another main category, is what's called land improvements. Okay, if you remember, we said land does not depreciate.
Right.
Land, it doesn't depreciate, so you have to subtract that from the value of the purchase price. But however, land improvements do depreciate. So for example, landscaping, okay, if you have a lawn, if you have trees, if you put in anything that's outside the building, like even pavement, okay, if you have a parking lot, you have curbing, if you have fencing of any kind, if you have signage on the site, even certain types of lighting outside the property, all of that depreciates on a 15-year schedule. So what we're doing through cost segregation, you're required according to the IRS rules, and there's a whole textbook called the Cost Segregation Audit Techniques Guide. Okay, I actually had someone last week who called me up. He said he heard about this cost segregation thing, and he was so interested. He stayed up all night long reading the entire book.
Oh my God, I'm sure that was very exciting reading.
I know, right? I usually tell people, like, you can, if you have insomnia, right, you should go and read this, right? Because it'll help you fall asleep. This guy read the entire thing cover to cover. It's actually online. You can Google it. It's part of the IRS website. The Cost Segregation Audit Techniques Guide, which goes through all of the steps and all of the processes of how to do cost segregation. So one of the things that's required is that an engineer who is very well versed in construction as well as in the tax code needs to come to the property. And it's one of the requirements. And so they need to actually look at the property, take a survey, take pictures, take measurements, everything in the property, is find out what in here actually depreciates, what fits into this 5-year schedule, what fits into this 15-year schedule, and what's left over as the main structure of the building in that 27-year schedule. What they'll do is they'll take all of those things, find the industry standard value for each thing, square footage, everything, prepare this huge long study that makes all the calculations and comes up and says, hey, guess what? Your property that you bought for $1 million, right? We said 800,000 depreciation. Guess what? 20% of that actually fits into the 5-year category. Okay, which means that instead of taking a $30,000 deduction every single year for 27 years, in the first 5 years, we're going to be front loading 20% of that. Okay, that means an extra, $180,000, $200,000 of extra depreciation in those first 5 years. That means instead of a $30,000 tax deduction, you may be getting a $60,000, $70,000 tax deduction in those first 5 years, which usually is going to wipe out entirely any tax liability from the property.
That's amazing. So that's just a one-time thing. So when you buy a property, you need to have that engineer come out and do this. And would you reach out to your CPA to find somebody like that, or how would one go about finding a person like that?
Right. So you can definitely reach out to your CPA, see if they have someone that they use, because it's something that, even though it's tax related, it's something that CPAs cannot do, because like I said, they need the engineer component of the study to go involved in it. So there are firms like ours, Madison Specs, we're a national firm. There are handful of other national companies and local companies around the country that specialize in this, that have, we employ engineers and accountants on staff that all we do is specialize in this service. So yeah, definitely reach out to someone like myself or your accountant to see if they know what this is. But believe it or not, which I'm no longer surprised at this, just because I've been involved in the business for so long, but so many accountants don't even know what this is. Okay. Even though it's in the tax code, and you can't blame them. The tax code itself is, massive. And this is one little tiny, part of the tax code. You can't expect for an accountant to be an expert in every single tiny nuance of the tax code, and they're not. And, that's okay. That's why there are specialties.
Yes. And that's why it's important when you guys talk to your real estate investors that you do talk about the importance of having the right accountant, right? That you're not just referring them to a general accountant who may not know anything about real estate, but they're specializing in real estate. And so that's definitely very, very important, because they could be missing out on a lot of deductions.
Absolutely. Exactly. So let me jump back to what happened with the tax reform. Because right now, up until this point, we described what depreciation is, what cost segregation, that component depreciation, breaking down depreciation into faster lives, which essentially, if you think about it like this, is just creating more income tax deductions, which equals more cash flow. Okay. The less tax you have to pay on your own money, the more cash in your pocket you keep. And that's huge. That's like the most important part for real estate investors, because what they're lacking most is cash, right? The more cash they have, the more they can invest. Okay. So this is a great tool to create a cash flow tool, right? It's like I like to call it like a fun tax savings, a fun cash flow tool instead of cost segregation, because that's just like a weird name and no one even knows what that means, right?
Right.
So
definitely much better way. So let me ask you this. So what happens if, say, after 5 years, I decide to sell this property? Right. Do I have to pay anything back, or, I depreciated this? Like, is it done? So, what are the tax consequences to me now selling this property?
Right. Excellent question. When you sell any property, right, along with the capital gains tax that you have to pay on the sale of the property, if you make a gain on the sale, there's another tax that comes along with the sale of a property called depreciation recapture tax, which is like really weird, and it's probably one of the worst taxes that's out there. But what it means is that after on the sale of property, you have to pay a tax on the amount of depreciation that you took. So if you took, and that's usually capped out at 25%, which is usually less than your normal, income tax rate would be. But one thing that's important to note when it comes to depreciation recapture tax, number one, you're not paying back the depreciation, okay? It's just a tax on that amount. So anyways, you're usually getting, through accelerating depreciation, through using cost segregation, you're getting the use of that money, right, during the course of the hold of the property, which again, it's like, you can look at it like an interest-free loan if you want from the IRS, which you're getting a lot more, paying zero taxes. And literally, like, this is why real estate investors like Trump, right, doesn't pay income tax, right? Jared Kushner, the New York Times headline, right? $300 million net worth, doesn't pay federal income tax for the last 10 years. How is that possible? Okay, one of the reasons is cost segregation. And that's because they're smart. They're doing it. It's not like tax evasion, God forbid. There's nothing they're doing wrong. They're doing it, they're exactly right how they're supposed to, because they're smart business people. But one thing that people don't talk about a lot is the depreciation recapture tax. Okay, so yes, you do have a tax that you have to pay upon the sale of the property. It's something important to keep in mind. It's usually going to be beneficial in most cases, as long as you're holding a property for at least 1 year. Then it will be beneficial to, the spread of, what you're going to pay later on versus what you would pay up front just seeing tax on that property. One thing that is important to note as well is that just like capital gains tax, if you do a 1031 exchange on the sale of a property, besides for deferring capital gains tax, it also defers the depreciation recapture tax. So
Wow.
you can push that off even further. So there are definitely options to use, again, something to speak with your accountant about and strategize.
That's amazing. And for those listeners who are not familiar with 1031 exchange, would you mind briefly just define what it is?
Sure. 1031 is actually a section of the tax code, and that's why it's called 1031 exchange. Just, for your edification, the tax code that discusses cost segregation is 1245, but we don't call it that. Anyways, 1031 exchange means that if you sell a property, like we said, you usually have to pay a capital gains tax, which means if you made money on the sale of property, you have to pay a tax on that gain. To simplify this, the IRS created a system in which you can exchange the property for a new property, meaning sell property A, buy property B, but do it within some certain specific parameters, okay? And they made it a little difficult. You have to do it within 180 days. You have to actually have a third party, a qualified intermediary, hold the money for you during that time. It's a little bit complicated, which is why you need to discuss it with an attorney or with your accountant to set it up right. But what you can do is actually defer those capital gains tax. Capital gains tax can be 25%, which means, or even more, there's actually federal capital gains or state capital gains. In some places, there's city capital gains tax as well. So, if you sell a property and you make $1 million from that sale, instead of paying that $250,000, that 25%, you can actually take that entire $1 million and reinvest it in a new property, okay, which will allow you to make a lot more money, because the more money you have to buy a property, right, the more money you can make from that property. If you just take a simple, right, 10%, cash on cash or whatever you have it. So that's a very simple explanation of how a 1031 exchange works.
And again, that 1031 exchange only applies to investment properties, does not apply to your primary residence.
Correct. Although you can sell a primary residence to buy an investment property through a 1031 exchange. Yeah.
Okay.
And the exchange itself, like I said, there are a lot of rules, but you don't have to, it's called, actually another word for it is called a like-kind exchange, which means you're exchanging something for something that's similar to it. So property to a property. You can no longer, according to the tax rule, you can no longer exchange anything else besides for real estate. You used to be able to exchange a plane, right? Sell a plane, buy another plane, sell a car, buy another car through an exchange without paying that capital gains tax. Now it only applies to real estate.
Interesting.
Yeah.
Okay. So that obviously the tax segregation sounds like it's an amazing strategy that is something that a lot of real estate investors probably are not aware of. And that's something you guys can discuss with them. And so you said that your firm is nationwide, is that right?
Correct. Yeah, we're actually one of the biggest national companies doing this. We work in all 50 states. We've done, at this point, been in business about 14 years and done over 15,000 studies. So we're pretty busy.
Very good. So if somebody has a real estate investor they're working with and they wanted to refer them to you, how would they go about contacting you?
So you can reach out to me on LinkedIn. It's actually a great place how me and Anya connected, but I'm very active there, posting a lot of content. But yeah, you can, my direct number is 732-298-9002. Feel free to give a call, get, a request. What we do, and which is very important, everyone should know, it's not like something, well, what is this? How does this work? What's the process? The first thing what we do is we always provide a free upfront estimate of what the potential savings will be, the potential tax benefits would be if you did a full cost segregation study, which, at that point, engaging to do a full cost segregation study, it's like hiring an appraiser or something like that. You actually have to pay. There's a service involved, right? But before that point, right, for educational purposes, we provide this upfront study, which our engineers will look at a lot of details in the property, like the square footage and the unit count, and, you know, location and year built, et cetera, which will give them an idea of what the actual tax benefits will be. And then you can use that information and kind of make an educated decision if that makes sense for your situation or not.
And how costly is this study? So, you know, relatively, like, is it based on square footage, based on purchase price? Like, what's the...
Yeah, it's totally based on the square footage and the scope of work, the type of property that's involved, not at all based on the purchase price or the cost, tax savings, you know, not contingent whatsoever to that. It's a really good question because, you know, we usually charge, it can range anywhere between like $4,000 to $7,000, depending on the size of the property, the scope of work that's involved. If it's a huge, massively large commercial property, it may be even more than that because there's a lot more work that's involved. But generally speaking, you know, it's in that range, 4 to 7. That being said, it's not going to be extremely beneficial for everyone, okay? Because the percentage of savings that are going to come from it is only going to be beneficial at a certain point, or a certain cost point. So my rule of thumb is usually if a property was purchased for over $500,000, it makes sense to get at least that analysis, to see that upfront estimate, to see if it's going to be beneficial for them or not. Anything over $1 million, it's almost a no-brainer. There's like so much tax benefit involved. We're talking about, you know, potentially 20% to 30% of accelerating depreciation, which can result literally in a net value of, you know, $100,000 to $150,000 for $1 million property. So to spend $5,000 to get $150,000 of tax savings is really, like I said, like almost a no-brainer.
Right, makes sense. So, and then say if somebody is working with the CPA who's not familiar with this type of a service with an engineer, so can they still do the depreciation, but I guess it wouldn't be accelerated, right? So it would just be over that 27-year
Correct.
period.
Yeah.
So
the CPA will just be able to do what's called the straight line method, which is just just straight line depreciating over 27 years.
Okay, that makes sense. All right. And Yonah, is there anything else that you want to leave us with today? Any last thoughts on, any additional nuances, any talking points that, maybe something that you see a lot of real estate investors do, or something that they're particularly not aware of that surprises you?
Yeah, sure. And actually, I wanted to touch on it before, but just the big thing that happened with the tax reform with cost segregation is something called bonus depreciation. Okay, they created this new law that allows you to take, it's called 100% bonus depreciation, which means anything that you would have cost segregated, that you would have accelerated depreciation from that 27-year schedule up to a 5-year to a 15-year schedule, any extra tax benefits, you can actually take that entire amount in year number 1. Okay, that means that extra $200,000 of tax deductions that we were going to spread over 5 years in our example, you can now take that entire $200,000 as write-off in year number 1, which is incredible. Okay, especially for people who are real estate professionals that can use tax depreciation to not only offset the income from their properties, but you can use depreciation to offset any of your income across the board, which means if you're making, or even if you're filing jointly with your spouse is a doctor, a high net worth individual, and you're a real estate professional, you can use depreciation to offset all of the income from your spouse, which
That's
means,
incredible.
Yeah, you may not be paying any income tax on your husband's $1 million, high net worth, W-2 job, if you're filing jointly and you have enough depreciation, this bonus depreciation especially, to offset that.
Mm-hmm. And there's specific definition in the code for the real estate professional, I believe, right? So you have to make sure that you qualify.
Yeah, exactly. Right.
Great. Okay. Well, thank you so much. This has really been helpful. So I think you guys, this is one that I'm going to go back to and listen to again and take notes, because it's definitely so informationally packed. And I was familiar with kind of depreciation, but wasn't as familiar with acceleration of that. So that's very interesting to know. And especially if you have investors purchasing model homes, oftentimes those model homes are well over $500,000. So that's definitely a good conversation to have with them, in addition to the rate of return that they're making that's well above your stock market rate. That is a good point with the tax deduction. So Yonah, thank you so much for being here today. I really appreciate that. I'll be sure to link all of your information in the show notes. And thank you again for sharing all the wealth of information with us.
Well, it's my pleasure. Thank you again, Anya. It's really my pleasure.
Thanks. Bye.
Bye.